and I'm going to sell my wheat or sell my corn, the farmer down the street who also trades isn't going to be taking the other side of my trades. What commercials and hedgers and fund managers and all the people who are really, let's say, professionals, they have become very, very sophisticated at finding ways of drawing the general public into taking the other sides of their trades. Meaning, and the point that I'm making here, is that they will purposefully do things that will draw the typical general public, let's say the general public, into the other side of their trades, when in fact what they want to do is the exact opposite. For an example, let's if I'm a hedge fund manager and I'm long stocks, or it doesn't really matter what it is. I could be long bonds, I could be long gold, I could be whatever it is, and I want to liquidate my position. Now I've got a huge position, meaning I've got a cash position and I want to sell it. If I go into the market right now and sell my entire position, what do you think is going to happen to the price? Chances are it's going to go down. I am actually going to, because of the volume of my trades, I am actually going to drive the price down, making my average cost lower and lower. I don't want to do that. I don't want to, so for an example, if I come into the market and I say, hey, you know what, I've got 10 million shares of this and that to sell, what's going to end up happening is that those 10 million shares are going to end up taking out all the bids, all the prices down, take out all the bids until you find a spot where it can't take out, where the size of the trade cannot take out any more bids and the price stabilizes. Okay? So I'm thinking to myself, now, what you get is you've got these, what I'm going to call like these hot shot kind of hardcore traders, where, you know, to make a name for themselves, because they're in a big trading room and they compete amongst one another and their bonuses depend on how well they do. What if they did something like this? I'm looking at a price chart. Let's just say they can be daily bars or whatever. Okay, and this is like a swing high, swing low, okay? Now, interestingly enough, as we're talking about this, I want to make a point about what does this price represent right here, and what does this price represent right here? What? Yeah, we're going to call it resistance, but more from a practical matter, what does it represent? What's that?
Nobody believes it's going to go higher.
Ah, yeah. In other words, there wasn't, no. You're right. He said that nobody believes it's going to go higher. It represents there wasn't one person in the whole world, that was willing to bid the price one tick higher. Not one. Up to this point, there could be any number of people who were willing to bid it higher. But it got to a certain price level, and there wasn't one person left in the whole world that would bid it higher. This, by the way, is one of the reasons why technical analysis works, is because the market has a memory. This is why technical analysis works. The market has a memory. Because when the market came back down, you formed a swing low, came back up to this high, there were people who made money by selling this high. There's a good chance those same traders are going to come back into the market and do it again. As well as there were people who lost money by buying that high. Because for every trade that was made up to this last price, there was a buyer and a seller. There was a trader on the other end of the trade that bought that high. Now when the market comes back again to the same price level, chances are there will be an imbalance between the buyers and the sellers. Just by the mere fact that the people who made money are going to be willing to trade it again and come into the market maybe with a lot of ferocity. And the traders who lost money by buying that high are probably not going to be willing to do it again. And so what you have is even more of an imbalance that existed the last time. Are you guys with me on this? Okay, well that's fine. You can do that. However,
are you going to explain that part, what they're thinking?
No, I'm not going to really the most I'm going to do is get into what we're just doing right now, because this is not, this is not a course in technical analysis. I mean, and it doesn't really matter anyway, because you guys are trading off of mathematical formulas and not doing subjective trading. So, and this would fall into the category of subjective trading. Subjective trading also is the equivalent to like who watches Texas Hold'em tournaments like on TV? Anybody? Come on, give me more of a show of. So you've got categories of development where initially people, when they play Texas Hold'em, you play your cards, and then you get good enough at playing your cards. What you start doing is playing the people, and you get good enough, you get so good that you don't even have to play your cards. You don't have to look at your cards, you just play the person. That's the equivalent to subjective trading, okay? What you're doing is you're using a process of deductive reasoning to determine who's thinking what and what they're likely to do, okay? And the only reason I'm giving you all this information and making this point is so that you understand with no uncertain terms that there's a whole category of traders out there, people out there, traders, people who have both the financial and the psychological resources to bid markets up and offer them lower. And what's the point that I'm making? The point that I'm making is that any particular technical methodology that you use to determine a pattern is present that gives you a higher probability of one thing happening over another, until you can get into the minds of the people who actually move prices, you will never know for sure what's going to happen next. The only people that know for sure are the people who are willing to do it. And that's what you got to burn that in your brain. You will never know for sure what's going to happen next, unless you can read the minds of the people who are going to do it. And there are people who will do it. And they do it all the time. That's the only way you end up in a winning trade. Most of the time when you end up in a winning trade is because of what these other dynamic traders are doing. So to convince you that there are people who are willing to do this, if I'm a hedge fund manager and I've got to unload, a huge position, and the market happens to be sitting right here in relative to this chart pattern, how might I maximize my profits? What might I do? Now remember, I've got to sell. I'm going to be a seller. But what might I do to make sure that I get the best price? What?
Drive it up and sell.
Yeah, drive it up. In other words, I will do the opposite of what I want to do to get a better price. And I will drive it up. But how much risk am I taking by doing that?
Probably not a lot. If you sell it just a little, drive it up, and sell a bunch coming back down.
Well, yeah, I mean, if I drive the price up by taking out these offers and then bidding up, taking out an offer, in other words, I can look with depending on the kind of software I have, I can find out what depth, the depth of the market, meaning that and I'm not saying these are hard offers, because people pull their offers all the time. But I can look at this high and I say, you know what? How much money might it take for me to drive the market from here to just past these highs right here? How many offers do I have to take out to do it?
Just tally it up.
Just tally it up and see if you want to spend the money. Because in essence, how much risk are you actually taking? See, by driving it up, what you're doing is you're increasing the asset value of your portfolio. So in that sense, you're not taking any risk. You're actually making money. If I continue to drive the price up, I am actually making the trades that I made down here winners. Every tick that I drive the price up, I'm making myself a winner on the trades that I made at lower prices. To actually drive a price up, because you are making yourself a winner at the prices that, what you bought at lower prices. If, for an example, by me driving this price up, it draws other people into the market, that will help, will it not? Because it creates more of an imbalance. Now, that's the real thing. What I want to do is I want to get more buyers into the market. And the reason why I want to get more buyers into the market is so somebody is there to take the other side of my sell orders. Because that's ultimately what I'm doing here. What I'm doing is I want to sell. So what I'm doing is creating a bigger pool of orders to come into the market till I can sell into, so that my sell orders don't drive the price down. And so I will purposefully do the opposite of what I want to do, ultimately, with respect to my position. Now, the reason why I'm selling has nothing to do with this chart pattern. absolutely nothing to do with the chart pattern itself. I'm just using the chart pattern as a means to maximize my profits. Now, what if I managed to drive it up to resistance? Chances are there's going to be a lot of sell orders coming in that I'm going to have to compete with. That's a risk that I'm taking here. But what if I can drive it a little past that resistance? What I'm going to have is a situation where all the people, the other traders who sold at this level right here, that came into the market because it was approaching this previous high, they're going to put their stops a little bit above the market. Now, what kind of stops are they going to be? They're going to be buy stops. If they sold to get out at a loss, they have to be buyers. If I can drive the market to those buy stops, I have given myself an instant pool of orders to take the other side of my trades and get me out at maximum profits. This is typically what you see in a chart pattern as a false breakout. Because what will end up happening is that as soon as my order hits the market, it's so large, and then because there really weren't that many other traders that were willing to continue to bid the market up, what it'll do is it'll take out all the bids and then drive the price right down. That's called a false breakout. It's being done at different time frames all of the time.
To do this, you have to have a large enough position so that when you drive up your cost basis, it's incrementally small compared to where you really are today.
Yeah.
And then, as you said, you get up to either you do it below that resistance, hope you break above, and then you just dump your shares.
Right. Right. The chart pattern as a means to maximize my profits. Now, what if I managed to drive it up to resistance? Chances are there's going to be a lot of sell orders coming in that I'm going to have to compete with. That's a risk that I'm taking here. But what if I can drive it a little past that resistance? What I'm going to have is a situation where all the people, the other traders who sold at this level right here, that came into the market because it was approaching this previous high, they're going to put their stops a little bit above the market. Now, what kind of stops are they going to be? They're going to be buy stops. If they sold to get out at a loss, they have to be buyers. If I can drive the market to those buy stops, I have given myself an instant pool of orders to take the other side of my trades and get me out at maximum profits. This is typically what you see in a chart pattern as a false breakout. Because what will end up happening is that as soon as my order hits the market, it's so large, and then because there really weren't that many other traders that were willing to continue to bid the market up, what it'll do is it'll take out all the bids and then drive the price right down. That's called a false breakout. It's being done at different time frames all of the time.
To do this, you have to have a large enough position so that when you drive up your cost basis, it's incrementally small compared to where you really are today.
Yeah.
And then, as you said, you get up to either you do it below that resistance, hope you break above, and then you just dump your shares.
Right. Right. Thank you. Now, like I said, this is. Did anybody ever wonder why, like you have a really strong bull market or a really strong bear market, and the market seems to open up in the morning, like in bull markets it opens lower, and bear market opens higher? Like, why does that happen? Well, what's the deal with that? What do you think's going on? You ever heard the term shaking out the weak longs and the weak shorts? That's what dynamic traders are doing. They're shaking out the weak longs and the weak shorts. In other words, they're taking their spot. Because what you have in a bull market is you have, people that, as the market's going up, this is a daily bar, but if we made it an intraday bar or whatever, as the market is going up, they're buying, people are buying, but they're not like really confident about what it is that they're doing. Now, in the morning, before the market opens, there might not be that many bids. In other words, after the market opens, there'll be more bids that come into the market, but before the market opens, there might not be that many bids. So if there aren't, what these dynamic traders will do to take advantage of this is they'll hit those bids. In other words, they'll sell They'll sell into those bids, drive the market down, and then when the market opens up, all of the weak longs, meaning people who aren't that confident, will start to get a little frightened, and to get out of their position, what do they have to do? They have to sell, and these other dynamic traders will take the other side of their sell orders to buy and increase their position, and the market goes right straight back up. All they did was shake these guys out, take their spot at lower prices by forcing the market lower on the open. Go ahead.
Isn't this an argument to have to either not use? Let's talk.
No. It is not. No, I don't want to get into the use or not. Absolutely, use stops. I'm not going to. We're not going to get into that. As mechanical, passive technical traders in the mechanical mode, this is not in any way saying that you should not use stops. Absolutely, it's a disastrous thing to do. Not use stops. Okay, because I'm not saying that regardless of any of this that you can't make money. All I'm doing is giving you examples that there are people out there who will drive prices up and offer them lower, that they have the psychological and financial resources to do it. And the reason why I'm making so much emphasis is that the typical passive technical trader would never conceive of actually bidding a market up. And so as a result, it's very difficult for you to think that anyone else can do it either. When the reality is that's the only way, in many cases, you're going to make money. And so the point that I'm making is that you're trading off of a mathematical formula. Literally, you're trading, and this mathematical formula, what technical analysis does is it gets into the collective mind of the market. In other words, every tick, every uptick and every downtick is information. That information is accumulated and mathematical principles are applied to it. There are actual patterns that emerge, that repeat themselves over and over and over again, that you can identify with mathematical formulas or with these visual price patterns. But the problem is that there's no mathematical formula that can get into the mind of the individual traders who actually are driving prices up or offering them lower. But if you don't know that, you somehow or another, if you're trading on a smaller time frame, and you get a little pullback right here, okay? And based on that pullback, your methodology says, okay, it's time to buy. And you do. And you do it just before this hedge fund manager comes in and starts driving the price up. See, you're going to think that the reason why you won is because your mathematical formula told you what was happening next. And that was the reason why it happened. What I'm saying to you now is that there almost isn't any reason that you could come up with, whether you won or lost, that would correspond to what really happened in the market. Do you hear what I just said? There's almost no reason that you will come up with to put on a trade that will ever correspond with the actual reason why the market went up or the market went down, other than the fact that there was an imbalance in conviction between buyers and sellers. Because the people who do this will not tell you unless it's in their best interest to do so. And the reason, the people who report it in the news agencies, they don't know either. They're making it up. They make up the reasons because they sound reasonable. They are paid to sound reasonable. And there's no way to verify what it is that they say.
Or to disprove what they say.
That's right. There's no way. The only people who can do it are the people who actually made the trades. The only people who know for sure what's going to happen next are the ones who are willing to make it happen. You see, we'll put on a trade and find ourselves in a nice monster little winner here and think, oh man, my methodology, it is just fantastic. And then the next time you get the same signal and then you don't get anything. Not only that, it's a loser. You think, oh, now you feel betrayed. You think your methodology let you down. Your methodology wasn't designed to tell you what's going to happen next on a trade-by-trade basis. No technical methodology is. That's where your expectations are not in line with the reality of the situation. That's why it's so easy to make mistakes. It's because you're expecting something from your methodology that just doesn't exist. It just doesn't. It never did. On a trade-by-trade basis. They will tell you what will happen. Let's say, I don't want to use the words to happen next. They'll tell you what will happen over a series of trades on a percentage basis. This particular pattern will emerge X number of times, and when it does, there's a higher probability of this happening than that. If I limit my risk when I take the trade, and my profits, my profit potential is at least 1 or 2 or 3 times greater than what I need to risk, then over a series of trades, I will be a consistent winner. That's what trading is all about, guys, as a passive technical trader. Unless you're doing this other stuff, I just said it right then and there. I said it all right then and there. There was a guy that came to me for consultations several years ago. He was he wasn't really anything. He was a guy that he was a guy that lost a lot of people's money. He was basically what he was. He was a really good analyst, I should say. Really, he was an excellent analyst. In fact, as far as market analysis was concerned, he was probably one of the best analysts I'd ever worked with. But the problem is that he had some really, as far as executing his trades, and let's put it this way, he was, let's say, on the arrogant side. That's being nice. And so when he put on a trade, he just thought that was it. The market was going to do what he thought it was going to do, period. So he was the kind of guy who, he went through all of his relatives' money with trading accounts and his friends and that sort of thing, and he was getting to the point where he was really exasperated. So he came to me for consultations, and basically after listening to him, I said, hey, you know what? Why don't you do something, get paid for something that you're good at, and and stop trying to stop losing other people's money, and go get a job as an analyst. Just get paid to be an analyst, not as a trader. And so he did. He got a job with one of the major clearing firms at the Chicago Board of Trade as one of their analysts for their brokers and that sort of thing. And the president, or actually the chairman of the board, his son was actually the president. Chairman had retired. He was an old-time grain trader, soybean trader, and made his money in the 40s and the 50s and that sort of thing, and traded pit-style trading. In other words, something that I talked about early this morning, I'm not going to get into, but in any case, he didn't make direction-related trades. And so he was really mystified with the idea of technical analysis. I mean, he really was. He was literally mystified with the idea that you could basically predict prices based on chart patterns and that sort of thing. So he thought, well, you know what? I'm going to sit down with this guy and this star analyst here that we have in the firm now, and find out what this crap is all about. Basically, is the way he thought about it. And so he's sitting down with him for a few days, and it got to a point where one day, the soybean market was. The soybean market was basically, trading in a range, about the middle of a range between what the analysts projected as the high of the day. Not just the high of the day and the low of the day, okay? And so the market drifted around, maybe did a little bit of close to a test of the high, and it's coming down to the low, and they're both sitting there and they're both watching it right now. And the chairman of the board, the soybean trader, old soybean trader, says, okay, so this is going to be the low of the day right here, right? The guy said, yep, that's it. Gets that price, it's the low of the day. Low of the day. And the guy looked at him and he said, that's bull. And he picked up the phone, which had a direct line to the soybean pit. And he said, sell 10 million beans at the market. Now, 10 million beans is 2,000 contracts because they trade in 5,000 bushel increments. So he hit the market at that moment with 2,000 sell orders, okay, which immediately drove the price down 10 cents, which basically is a $1 million trade, by the way. Driving the price, of course, if he'd have sold all of them at this price and bought them all back at this price, but there was an average price down. But from here to here is $1 million on 2,000 contracts. And then after the price dropped, he looked at him and said, hey, if I can do that, anybody can do that. If I can do that, anybody can do it. Now think about the implications of what I just said. if you remember back in that survey that we just took a little while ago, and I said it only takes one trader somewhere in the world to negate the positive outcome of your edge? Oh, gee, what if you were one of the people that bought right here? How many people did it take to mess up your trade? Just one. Just one person. That's all. It's usually more than one, but that's all it takes is one. You guys starting to get the idea? This kind of stuff is going on all of the time. As a matter of fact, when prices move, this is usually the reason why. When I was at Merrill Lynch, and for many years, even when I was teaching, material in the psychology of trading, I didn't really include a lot of this stuff because I just sort of took it for granted that people understood it and knew it. And the reason why I took it for granted is because I guess I learned it so early in my trading career that it just, it was self-evident to me. But it was self-evident because here I was at Merrill Lynch and I had access to a squawk box. Now our squawk boxes were open phone lines to the various pits in both Chicago and New York, meaning we had Merrill Lynch representatives in each of those pits that as buy and sell orders would come in, they would tell us who was buying and who was selling. What houses, what manufacturers, what big accounts, what big traders, if they could. In other words, if they had access to the information, they would tell us who was buying, and maybe who was even taking the other side of their orders if they could determine it. So it's like you had a very intimate, it was like you had this sort of intimate connection with what was really going on. Now, at the same time, when I was doing my own technical analysis, I would do my equations because we didn't have computers back then. Of course, you could do the Hewlett-Packard handheld thing, but I didn't do that. I did all my equations all my analysis on a spreadsheet, and I actually did all the calculations by hand. And I did it on purpose that way so that I could get an intimate sense of how the actual mathematics of my signals, in other words, the actual calculations, the multiplications, the divisions, the subtractions, and what the final product was in terms of a signal, how it related to the actual market movement. And I found that there was no relationship other than the fact that it would identify patterns where the signals would work sometimes and sometimes they wouldn't. But the point is that there wasn't any relationship between this fixed mathematical formula and the people who were buying and selling at that moment and the reasons why they were doing it. There was none at all. But not only that, here's what really shocked me, is we had TV monitors going all the time. And we had it on, in Chicago, there was a local investment channel, Channel 26. And it was very much like CNBC now, but it was a lot less sophisticated. And, so we'd watch as people would come on the show and with various, have various interviews and that sort of thing. And I'm watching one morning, and there's this vice president from Heinhold, which now doesn't exist anymore, but they were one of the biggest hog and meat producers in the Midwest back in the 80s. And this vice president from Heinhold is being interviewed by the guy on Channel 26, and he's talking about how people got to get into live hogs and pork bellies because prices are going up, and and he's just going on and on about what a great investment it is, and really here this would happen quite frequently, by the way, but this was just an example, and then all the phones started lighting up. These are all the people in the Chicago area, the typical, the traders in the Chicago area that are listening to this guy, because when I say that, because the phones are lighting up and all the brokers are starting to take orders to buy bellies and buy hogs. And I'm thinking, well, that was pretty impactful, right? Oh, gee, and then on Squawk Box, guess who's taking the other side of those orders? Heinhold. They needed somebody to come in and take the other side of their orders. What does a mathematical formula have to do with that? Now, as it just so happens, if my math is working in a way where I happen to get in at that moment, I end up in a winning trade, well, that's great. But that doesn't mean I can rely on it to do the same thing the next time. Okay, I explained hedging, reverse auction. In a normal auction, this is what I'm talking about dynamic traders right now. In a normal auction, what do people do in a normal auction? In other words, if you're in a situation where things or items are up for bid, when you bid, when you're outbidding somebody, what are you doing? You're eliminating the competition, right? In other words, by bidding higher, you're hopefully eliminating anybody else who'll bid higher than you. Hedgers and commercials and dynamic traders create what I call a reverse auction. They'll bid a market up or offer it lower to try to attract the public into the market to take the other side of their trades. You guys with me on this? They will bid a market up or offer it lower as a reverse auction. That doesn't mean that they want the market can go higher, but their immediate objective is that if they're bidding it up, it means that they want to sell. They just want someone to take the other side of their trades. So they're actually creating a reverse auction, attracting people into the market, because as the market goes up, people are thinking, okay, I'm going to be missing out. And I've got the assurance that I need that it's going to keep on going. And so they get sucked into this move, and then they slam them with a huge order. Now, see, I had intimate contact with all of that at Merrill Lynch. I really, not only that, I mean, because I knew the floor traders, I knew many of the floor traders who actually created the movement that particular day. And there were a number of times where the movement was significant and they were fast markets and enough to attract the media to the exchange, and they put a microphone in front of their mouth, and they definitely would say something that was palatable to the public. In other words, what was reasonable. I can guarantee you that the reason why they did what they did during the day had nothing to do with what they said. Nothing. There was no relationship whatsoever. Go ahead.
I fully understand your concept of the movement that's taking place because of dynamic players. And I can understand how that would relate to the commodity, stock, and stock options market. But can you have the same effect in, say, the foreign currency market, where it's a much bigger market that's traded worldwide?
It just depends on the player. Absolutely. You get a central bank that starts unloading something, and then it's gonna have a major impact on the market. Yes. But you've got basically what you have is a situation where this market's so large, it's so liquid, that it would be very difficult for individuals to have any impact on it. Is that what you're saying to me? Is that what you're...
Well, I wasn't necessarily limiting it to individuals. I mean, even a central bank on the world market, could they have that kind of an impact?
Well, it's what I call the pebble in a pond effect, okay? They might not have enough impact initially, okay? Initially to do something, okay, to have that meaningful, to create that meaningful of a price move, but you've got a pebble in a pond, which is the way a lot of prices move anyway, because it's like what you got is you drop a pebble in a pond. Well, if it's, it creates waves, does it not? Okay? And what I found is that, especially with floor traders, and really the same kind of dynamics work even with off the floor traders in the general market itself. I found that what you had is that most floor traders did not know what they were doing, in the sense that they didn't have a real good reason for buying or selling at any given moment, other than the fact that they were following the lead of other people who they thought did have an idea of what they're doing. So what ends up happening is that what you've got is the guy, the trader who's confident, knows exactly what he's doing, why he wants to do it, and does it. And then you've got all the other guys who are, let's say, in the pit, okay, who are closest to this guy might be on this step right here, who are closest to this guy, that will mimic what he does. And then what it does is it starts spreading out. And that as word gets out, okay, the guys at the farthest end up getting prices that are greatly diminished in relationship to this particular individual. But the point is, it's kind of like the pebble in a pond. A central bank could create the same thing. In other words, initially, a central bank hitting the market with a huge order might be absorbed, but the fact that the central bank is doing it will cause other people to want to do it too, and therefore, as a result of all the other traders who pile on, it creates a huge move. Does that make sense? Okay, we're moving right along here. Okay, dynamic traders, okay, players. They know and understand the mindset and behavior patterns of the crowd or herd. They basically refer to the general public as the herd, and they are the herd masters. Okay, they are the herd masters. Whenever possible, they will use that knowledge to move prices in a way that will extract the most amount of money from the largest number of traders. That is their mission. That is what they do. Characteristics of passive technical traders, they're usually mystified by price movement. Would that be a fair characterization? Okay, they wouldn't think about trying to cause price movement. As a result, they typically can't conceive of anyone else doing it either. They're typically drawn into trades based on an opinion about the attractiveness of the price or stampeded out because of fear. The passive technical trader's objective is to find himself in a winning trade without any intent to move prices. Now think about what you're doing. You are trading in a way where you want to find yourself in a winning trade, but absolutely wouldn't even think about moving prices to do it. You're completely dependent on someone else doing it for you. To find himself in a winning trade, he's dependent on other traders to be willing to either buy or sell at a worse price than himself to create movement in his direction. The typical passive technical trader is expecting other dynamic traders to make him a winner when they usually have little or no knowledge, insight, or understanding about how dynamic traders operate. Would that be fair? The typical passive trader does not realize it only takes one dynamic trader somewhere in the world to negate the positive outcome of his edge. Is that a fair statement now? Does anybody want to argue with the statement anymore? And I'd say anybody did in the first place, but there are some people who raised their hand and said that that wasn't the case. Is there anybody that's not convinced about this? Seriously, I want to know. And we're not going to get into a fight or anything, but you know. Okay, the characteristics of technical analysis. Now what we're going to do is we're going to take what we now understand about the nature of price movement and look at the nature of technical analysis to just see what we got here, okay? See how well it meshes. Okay, technical indicators define, identify, and organize market data, the up and down ticks into understandable patterns. Are you guys with me on this? The patterns are observable, quantifiable, meaning they can be measured, and repeat themselves with statistical reliability. And really, while I'm doing this and while we're going through this, I want you guys to really keep in mind that just because I explained the underlying characteristics of dynamic traders and people who can actually move the market and do it all the time, in fact, when the market's moving, they're the ones who are doing it. It's not you or I. The only time you or I move the market is when there's an overabundance of market orders coming into the market from passive technical traders. Because a market order does what? Okay? If the last price is 10, we've got 9, we've got 11. Okay, what's the market? The last price is 10. If I want to buy, the market's actually 11, isn't it? That's the market, because that's where the offers are. The offers are at 11, so that's where I'm going to get filled. I'm going to get filled at 11. Well, if there's so many market buy orders coming into the market, and all the offers are taken out at 11, then that means the next price up where there's offers are 12, and that's where I'm going to get filled. And if there's so many more that got in before me, and this is real, I mean, it's really an overabundance of buy orders in relationship to the number of offers that exist, then I might get filled at 13, because that's the market. So that's the difference. You've got an overabundance of passive technical orders coming into the market that will drive it up, or you've got dynamic traders who are doing it purposefully. And when they're doing it purposefully, I guarantee you, they got a good reason for it. They know what they're doing. I'm not saying it always works, but they know what they're doing. And it doesn't mean that you can't take advantage of it. It doesn't mean that you can't make a consistent income, even a really good consistent income with your technical methodologies. You don't have to understand all these subtle dynamics of market or price movement to be able to take advantage of it. All you've got to do is be able to trade your edge and follow your plan. I just want you to understand that when you understand what's going on, you will be able to trade your plan because you won't be putting so much emphasis on things that don't have any relevance.